Welcome, everybody, to the role of private equity in providing liquidity, and welcome to the 2017 Montgomery Summit presented by Macquarie. My name is David Dorfman, and I'm with Macquarie, and I'm the head of our technology, media, and telecom investment banking business, but this week I'm most proud to be a friend of Jamie's. When I think about private equity and role in providing liquidity, for us it's often at the far end of what we're talking about this morning, but it's no less important. And maybe just for a second on Macquarie Commercial, we are currently and forever will be 2016's Technology LBO House of the Year. 14 book run trades, in part with Alan and Vista we'll get to, but the dynamic that we're seeing in the market right now, the M&A, the liquidity, the think about the IPO this week for homegrown Snap, it is pretty phenomenal. In a bit of a scary way, it reminds me of 2006 and 2007, and the example I'll give for that is most recently Macquarie was involved in providing the financing for KKR to buy endpoint security business Optiv from Blackstone. Now, before KKR stepped up and bought Optiv from Blackstone, Blackstone was down the path of bringing that company public. So when you think, and I mean, this will be interesting to think about M&A versus IPO as well as other exits. But when you think about 2016, just a few fun facts, maybe the panel can pick up on this or not. But 2016 global technology exits. This is global. There were 3,260 exits via M&A. There were 98 via IPO. That's 3%. We've heard a lot about the dearth of IPO and tech IPO the last couple of years. Those stats are pretty much the same the last couple of years, plus minus a point. So while there's been a few less tech IPOs, it's about 3% go IPO, and again, 3,260 in 2016. 3,260 went via M&A. That is the exit of least resistance and I think mode most frequent for tech exits. What else is going on? Two other facts. Multiples all-time high. We see this every single day, and again, I think it's a good topic for the panelists as they think about putting money to work. When we think about 11 to 14, sort of the EBITDA multiple was around 14 times. When we think about 15, 16, and what we're seeing in the market today, it's picked up to 17 times. Now, it's not insignificant, those three multiple turns, and you pay that, you got to hope you get that in year 3, 5, 7 when you exit, or you have to grow cash flow to overcompensate for that. I would say in the final point, valuation. For total M&A, again, in that 11 to 14 time frame, it was running or clipping along at about $200 billion for the industry. The last 2 years, $500 billion. So great for all of us in this room. It's been fun to be a participant. It's been fun to be at Macquarie. It's been fun to be friends with Jamie. And with that as introductory remarks, let me please introduce our panelists. We have Peter Chung, Managing Director and CEO of Summit Partners. We have Alan Klein, Principal at Vista Equity. We have Nelson Griggs, who is Global Corporate Client Group at NASDAQ. Chris Hyland, former CEO of Citrix. And our moderator, the very well-regarded and almost not here, Sarah McGraw from Bloomberg. Thank you, Sarah.
Thank you. Good morning, everybody. Thanks for coming to this panel. It's going to be a great discussion on private liquidity. And I thought we could kick it off by asking each panelist to quickly introduce himself, starting with you, Alan.
Sure. So Alan Klein, if you're not familiar with Vista, we now manage about $28 billion capital, entirely focused on software and software-enabled businesses. Starting a few weeks ago, we now have actually three equity funds that allow us to span from about 12 million in revenue up through several billion in revenue, depending on kind of size and stage of the investment. And we've been extremely active. And so over the last, since inception, we've acquired about 214 companies. Last year alone, I think it was 43. Most of those are add-on M&A to existing platforms, kind of a 1-to-3 ratio of platform to add-on, and continue to see, frankly, 17 is another very active year despite very high valuations. And that's the point of view I think we'll represent here today.
Terrific. Peter?
I'm Peter Chung. I'm the Managing Director and the CEO of Summit Partners. We're a global growth equity firm based in Boston with offices in Menlo Park and London. We invest in the technology, healthcare, and growth products and services sectors out of 5 different fund products. Roughly half our investments are minority growth equity investments. The other half are controlled transactions or growth buyouts.
Great. Chris?
My name's Chris Hyland. I spent most of my career actually operating and leading SaaS businesses. The last one was about $1 billion business inside of Citrix that we ultimately spun and merged in a transaction that closed in January with LogMeIn. I've also served on the board at ADT, which we took private last year in about an $8 billion transaction with Apollo.
Nelson?
Hey, I'm Nelson Griggs. I'm an Executive Vice President at NASDAQ, head of our global listing business, which is comprises about 2,700 companies in the U.S. and 800 in our Nordic markets. I also run our NASDAQ private market as well.
Great. And I'm Sarah McBride. I cover venture capital and startups at Bloomberg in San Francisco. So given that's my background, I thought I'd start with a fairly basic question. There's so much venture money that's kind of reaching up into a space that was traditionally associated with private equity, and private equity's kind of coming back into areas that are more like venture capital. And so I thought I'd ask our panelists to explain, in this climate, what do you see as the difference between private equity and venture? And Peter, maybe we'll start with you.
Well, some of that is industry taxonomy, which is lost on the average observer. But if I were to give you a basic definition, private equity are typically cash flow buyers, right? The traditional leverage buyout firm, you're buying a stream of free cash flows or earnings, whereas venture capital, in the traditional definition, is funding development risk or funding technology risk, and the expected returns, expected outcomes for those investors are somewhat different. The traditional private equity or leverage buyout asset class would rely on the use of debt financing or leverage to enhance the equity return in combination with the underlying revenue or profit growth. Today, now there's sort of it's more of an analog as opposed to a digital spectrum of investment styles and targeted companies, and so we would do a little bit of both. We probably sit a little bit in the middle between traditional private equity and venture capital. But that's the historical definition today. That's become much more, as I said, an analog waveform as opposed to sort of discrete silos of investment styles.
Sure. And Alan, Vista has become known for operating in many ways more like your traditional venture firm. How would you see the distinction?
So like Peter, we look at it as really a continuum where there's capital in all different spectrums, and frankly, north of 1,000 firms that are kind of articulating their own point of view on where they're going to sit. And you can almost look at either end and say, you can define the extremes, and then most folks lie in the middle. So whether it's a venture firm predominantly buying a minority interest in a business, or a private equity firm predominantly buying control. And I think the risk question Peter raised is really the most important one, which is, what risk are you willing to take on for your limited partners? And in our world, we want to be beyond product market fit. We want to be beyond proving that you've got a large enough niche market to build a real business out of, almost by definition. And we'll slide all the way down to the spectrum on that side. A lot of times, folks would say, well, it's on the cash flow question, which I think is a good one. I'd say probably 30% of the companies we've bought in the last 2 years were not cash flow positive when we bought the business. And again, it's a controlled transaction, sometimes an add-on to one of our existing businesses. And then, frankly, companies like Marketo, which are market leaders, still growing very nicely, but they've reached a point of maturity in their cycle where both they'd outgrown the venture market and, frankly, were a little bit of an orphan stepchild from valuation perspective in the public markets. And our view is their strategy was going to be enhanced by being able to take a longer term view on investments and changes to that business as they expand their market potential. So I think every firm's going to look at it a little differently. That's predominantly how we define it. And that continuum is kind of ever changing for different firms.
So Alan, your firm was involved in a transaction last year where I actually saw a fairly entertaining tweet on private equity transactions, which is rare. But when Ping, which is a kind of identity verification company, was taken private last year, Mark Andreessen, the venture capitalist, tweeted out, "Outstanding, clearing the field for the new 800-pound gorilla, Okta," which is his portfolio company. And then my journalist colleague, Dan Primack, who at the time was still at Fortune, tweeted to him, "Clearing the field? Do you think Vistas taking it out back to shoot it?" And then Mark Andreessen tweeted back, "Well, taking it to live on a nice farm upstate, if you know what I mean." So, Chris, as somebody with actual experience, on the board of a company that was taken private, what would you say about that exchange?
I'd like to build off what these guys are talking about.
Okay.
We was at ADT, the security company,
Right.
and been around for 35 years. And we faced a situation where our business model wasn't really in vogue, right? We put a lot of cash out, we install system in your thing, we get cash back, recurring revenue, but we couldn't get a valuation. We always struggle with our valuation relative to what we thought the health of the business was. When we really looked at what we had to do, and one of the reasons I was brought on the board was my technology background, is if we had made the changes we wanted to make in the public market, the stock, which was trading at about 27 at the time, probably would have gone to $14 to $16 a share. And so when we got a bid in from Apollo, we got the bid at $43.50. I think we closed at $42. It was like we had to do it. And the reason we had to do it is the company was a good, healthy company, but in the public market, you couldn't, in the long term, make it a really healthy company. And so I think to your point, we went through a similar thing at Citrix, where we had grown from $100 million valuation to a $3 billion valuation. We still thought of ourselves as this 20% grower, and the fact was we were a 3% grower. And so I think sometimes the mindset goes with you, but you just have to make the call, and you go private. You can fix it and create a lot of value in the longer term, and then go back to the public markets when you've got a viable entity.
So Nelson, when companies listed on NASDAQ are going through this thought process, how can you advise them? What do you say to them to perhaps change their mind of something that Chris just described?
Yeah, I don't think it's our role to change their mind. I've never, part of our role is to meet with all of our existing companies. We've never met a management team that likes their valuation. But I think that the biggest challenge they have today as public companies when you get to certain size is how do you grow? We're a public company ourselves, NASDAQ, about $12 billion, and that's our constant challenge is how do we grow and keep up with investor demands of a quarterly filing. So I think the public market is right now challenged. We have about half the public companies today in the U.S. than we had 20 years ago. Q3 last year was probably one of the biggest M&A quarters we saw in the last 3 years. We ended up with fewer public companies end of the year than we started the year because it was a pretty anemic IPO year. So I think that's a big challenge facing the public markets is we can fix some things around the challenges of being public, which we think this has the opportunity to do from a regulation perspective, from the burdens we put on companies. But the real challenge is the short-termism of the marketplace and how do you pivot your market when you're trying to or your business if you're trying to meet a quarterly number. So we don't really have a good answer to that one yet, but certain companies certainly have looked at the opportunity to go private and really transform their business, and that's certainly a viable option.
Right. So yesterday I noticed that a group of investors had gotten together about Snap, and they're very concerned about the degree of founder control that Evan Spiegel has, and they've written to some of the groups that create indices and asked for Snap not to be included, in particular in the S&P indices and some of the NASDAQ indices, and it's because of this degree of founder control. So if that were to happen, that would be highly unusual, and perhaps Nelson, you could talk a little bit about the index process, if that's ever happened, what type of effect it might have on a company's stock.
Sure, I'll make two comments. One, 10 years ago, so I think people in the room are probably familiar with different classes of shares, A, B shares for founder control. And 10 years ago, 2% of the IPOs had that construct, and last year it was 12%. The majority are going to be your growth companies where they have the control to do that early when they have the kind of the power. So I think you are seeing a lot more movement to the AB. Now the snap class shares were something we've never seen before with no voting rights. And from an index perspective, the two biggest trends right now in the marketplace today are passive investing and alternative investing. There's a lot less liquidity in the traditional trading environment. So indexes play a key role. That's a pretty unique company where it may or may not have an impact, but there's different indexes out there. NASDAQ 100 is a very prescriptive index, black and white. We know the rules are published. There's no committee. It's the 100 largest non-financial NASDAQ companies, so they would never have a rule that would say, hey, a company A, B can't go in to the index. The S&P is an index that is going to be a committee, and they have to decide if they think this is prohibitive to not have voting rights. So those indexes are a way for shareholders to benchmark and track, but there's only a small handful that have very big power in terms of how they can move shares. The S&P is one, the NASDAQ 100, and you have the FTSE. But a lot of indexes out there. NASDAQ alone has 40,000 indexes, and most are more for benchmarking. So I don't see this being a huge event.
You don't think that'll work out?
Well, it's up to the S&P, and I wouldn't want to speak for them. So that's we'll see.
Okay, and then.
But it does speak to the whole idea of founder control and
Right.
ownership, and how do you want to set that up early enough in the process so you do have the company, if you ultimately go public, that you do want to have control, which is important because activism is a leading issue today for public companies.
Right. Alan, you work at Vista, which is famous for having a playbook for what it does when it takes companies private. Can you talk a little bit about that? And in particular, I've heard there's a test that you give executives to decide if they're in the right role.
So to speak to that, I wish we had like a full playbook because it would be great if we could just hit the field and 42 left, sweep, and we'll score touchdowns every time. What we've done over 17 years has been to really take all the observations we've been able to garner through our portfolio companies on what's worked for them and make sure we bring it back into Vista as a cataloged Vista best practice so that when the next company come in the portfolio has a similar challenge, they can basically stand on the shoulders of others before them and leverage that prior experience to accelerate their own plans, right? And so it's not to say, hey, I've got a list of the 10 commandments and thou shalt not do these 10 things. It's more, hey, what is your strategic plan? What are you trying to accomplish? What's working well? And frankly, are there things that others in the portfolio can learn from? And where are opportunities for the future? And what have you not done that you would like to expand into? And frankly, making sure we're bringing all that back in to leverage across the portfolio. That has taken, over 17 years, that we've probably gone through 5 iterations of that in terms of what it is. Where it sits today is we've actually built a dedicated consulting practice exclusively for use by the portfolio, which is by the drink access to 90 different experts in every different area of software. So if you're making a big Amazon Web Services transition, I've got an excellent hosting guy that can help you with everything from the design to the contract to thinking about storage management and how you think about, ramping up and ramping down dev servers, because it's different when you got to pay by the drink, right? And so all of those resources will allow your team to have a peer level expert help them be great at their job. And so that's basically a big piece of how we do that. The second thing we do is a lot of cross-portfolio kind of collective work. And we find that executives, particularly at the level below the CEO, find a tremendous amount of value about having a peer network of other folks at non-competitive companies, frankly, solving the same problems. And so we do a lot to help facilitate that knowledge sharing and that peer network, with the goal being we want every company to basically achieve their highest potential, whatever that potential may be. And we've got some companies that are going to grow 10%, and they're going to work really hard to grow 10% because of the maturity of their market. And we have some other companies, 2 board meetings this week, that are with companies growing 30 and 40% respectively, and they're probably 10% below their potential. I mean, there is more opportunity there, and our dialogue there is very different about the resources they can leverage. And we do use a whole variety of things in recruiting to help build teams, because as much as software companies are about the code, it's really about the people. And the number one challenge I think we find almost every prospect we run into is, how do I build and recruit great growing teams of people when I get to certain different levels of size? And it doesn't matter what size you are, the next level always feels like a really hard one, because it's a permanent problem. And so I think our view is, if you really invest in really good recruiting, hiring, and most importantly, training programs, you can build extremely good teams in virtually any part of the United States, predominantly cities that have a engineering-based university in the town. So you can pick 200 of those.
So what about the Myers-Briggs type test? Is that true?
So we do use, there you go. We do have an assessment for every employee. I've taken it myself, and it is basically a view of, there are a few things that are really important. So there's half of it is basically a quick aptitude test. That part takes about 15 minutes. And it's really great at helping you find entry-level talent in hidden places. And what it does is a super shortcut way to determine, irrespective of educational background or prior employment, who is really good at logical thinking and quantitative problem solving. And so when you're now, as an interviewing manager, interviewing someone that has done well in the assessment, you don't have to say, wow, they went to XYZ, non-top 25 college. Do I need to worry about, are they smart enough? You already know they're smart enough, right? You can look past many of the superficial things that are used in an interview that are actually, frankly, poor predictors of performance, and then focus on the interview, the things that we are really good at in interviews. Do I like you? Are you going to be a good cultural fit? Do you have good communication skills? Are you going to be a team player? Frankly, the interview is excellent at those things. And so what we try to do is marry those two things together to basically help you identify, particularly when you're hiring new folks with very short resumes into the bottom of the pyramid of your organization, to get the best group. And quantitatively, sorry, one last thing here. Historically, software as a whole has about a 50% failure rate of hires when you go 3 to 4 years out. 50% of the people you've hired are either basically on a performance improvement plan or no longer in your organization. It's pretty high, right? You put all this effort into hiring, recruiting, and training, and half don't work out. And so basically what we found over the last, it spans even before the time we started Vista, you can basically reduce that to, you can get rid of about half of that error, which for us is a huge productivity improvement, because there's nothing worse than investing in someone for 3 or 4 years and they don't work out for whatever reason.
Have you ever radically changed the role of a more senior person based on the results you see from?
No, this is the great myth is, there's an assessment and you're either fit for the world or not based on it. The way to think about it is it is not dispositive. There's nothing you can do with an assessment that's going to determine someone that's going to be great or not. It's just going to help you understand one small dimension in the assessment on a broader piece of a much longer conversation on kind of hiring and personnel development. But I can't think of a single executive that has ever, it's just not used that way.
Okay. So Peter, what would the summit version of the Vista aptitude test be? Do you have anything like that, or do you think that's a bit too?
Sarah, we built, like Vista and several other firms, we built our own in-house value enhancement team. So we have an in-house operations team, an in-house talent team, an in-house capital markets team. We make those teams available to our portfolio companies. I'd agree with Alan in that one of the more common needs for growth companies is a better system to evaluate talent and to increase the stick rate, as our talent head calls it, of new hires. I will say that it is there's a bit of false precision that's implied by some of these tests and systems and so forth. You can't necessarily test for long-term ambition or certain dimensions of personality fit or cultural values. They're just not. There's no axiom or algorithm that can give you a discrete answer. Having said that, I do think that it can help you miss some obvious signs, perhaps. I'll tell you a funny. I'll start by saying, if we tried to do this internally. We had sort of a personality type test conducted around on many of the senior members of our team, and the results look like a Rorschach test. There was no best fit line to be drawn through any of the various data points. It was very difficult to conclude that, despite the fact that we're known as a firm that has a well articulated culture, in point of fact, that's actually not true if you were to look at the personality types of the senior-most people. I can tell you that on the hiring front, we are doing this a little bit more with our portfolio companies. We found that sometimes, you do find some interesting observations to be learned from an industrial psychologist or someone who's trained in the field of detecting something.
Can you give an example?
Well, I'll give you one of an example that a mistake that I made many years ago in a company that won't be named. The company was selling a very, very technically complex infrastructure software product. We struggled for a long time to find a head of sales. What you learn about software salespeople is they're very good at selling, in particular themselves. They're very good at selling themselves. So many of them have lots of jobs and they bounce around and so forth, and there's probably a reason why they had different jobs. Well, we ended up hiring somebody from a globally recognized enterprise software company, and he seemed to be doing a good job. But as we started to pull apart some of the performance data and get some chatter back from his direct reports, we started to have some concerns. We ultimately sold this company to another large company, but after the sale was completed, the CEO started to tell me some stories about this person's expense reports. And this guy was flying to Milan for the weekend and buying suits and expensing them and things like this. And everybody who's been an investor in a enterprise software company has stories like this. But I think that's the kind of thing that could be detected early on if you really knew what to look for. If you are interviewing, you're probably looking for pattern recognition or points of connection with someone that may or may not be relevant to their cultural fit or their aptitude for the role for which you're interviewing. And I think that's where this type of screening